Absolutely. If you look at default rates, they are half of the level of what we saw back in 2000 and 2009. In those two crises, they were around 12%. So far this year, we have seen something in Europe close to 6%. So at the macro level, you've seen a situation which is much worse than what you've seen in the last crisis. It's the worst economic crisis in the last 100 years. But when you look at the market, when you look at companies, it's actually been better than what you saw both in 2000 and 2009. And still today, that resilience, the fact that governments and central banks are there to help to ensure that this crisis is nowhere like we saw in 2009, where then you had the euro crisis after. We don't need another crisis. And that type of support means that when you have companies with sound fundamentals, good balance sheets, even if they got good leverage, this is a time to start to look back at these companies.
Francesco, good morning to you. And yet my concern is that because the default rates are low, it's because of that largesse you just mentioned with the central banks and others stepping in as well. But we're creating zombie companies here. People keep talking about fallen angels, a term which I only heard this year. Surely more of these companies are not fallen angels. They're just companies that are just being kept on life support. They're zombie companies even when we get out of this crisis.
There are zombie companies up to a point. They're only zombie companies because there is no demand. But if we look at the supply side for these companies, we never saw the massive overspending in the last few years. That means that there is a problem of supply. There may be some problems of supply in the space of retailing, because clearly this shift to online spending may have been a structural shift. But overall, at the market level, I don't see that type of significant issues with oversupply, versus the demand that was there, a year and a half ago. And this is where the focus of policymakers has to be, is to make sure that after these economic crisis, when the vaccine finally has its effects, we get back to have the demand that we saw in the past. And this is essential.
Francesco, I want to ask you about dividends. We've heard so much over this corporate reporting season about those payout to shareholders, and I know some of the corporates try to resume the payouts where they can, but you've got a repeat of 2009 scenario. Just walk us through what those expectations are and what you've heard from the C-suite.
Well, the interesting story back in 2009 was that the earnings bounced back within 2 years, but then it took companies back 5 years to go back to the same level of dividends that you saw back in 2008. And to a large extent, this is one of the important components for long-term investors, because dividends have got such an important factor on the total return for equities, especially given the high valuation. Dividends will be an important component. So from us, this component at the moment, we are still forecasting that it's going to go back to the same level as we saw last year, back in 5 years' time. And this is why, to a large extent, our expectations in terms of long-term returns is for the market, for the equity markets, close to something like 5% altogether, because dividends, we expect only a slow increase of dividends. And let's not forget that one sector that has been a significant contributor to dividends is the financial sector. And clearly, what the governments will want is for those financial companies to keep on taking the burden of lending to the real economy and not to increase the dividends immediately. So we need sort of to maintain that cautious approach. But having said that, clearly for investors who shouldn't be scared about some of these sectors, because if there are some sectors that have done terribly this year, are the traditional dividend-paying sectors, and this is where the most attractive opportunities are in the market.